This conference will now be recorded.
Okay, good afternoon, everyone. It's Paddy Osborne here on Friday, the 5th of August, doing our weekly market insights. And this week, we're going to have a chat about some of the macro data that's come out this week. So, checking on the screen here, we've got a couple of big events that happened that moved the market. It's absolutely vital to really understand what this data is, what it means, and what sort of effect it'll have on different markets. And so, I've got two very good examples here of how one, bank policy, and two, employment data has affected the price of some assets. Now, this is on the screen here, the economic calendar. If you are trading, you must always look at the economic calendar. It is a calendar of economic events, macroeconomics. It's the big stuff that moves markets. Most of these calendars are designed for FX trading, but they will, as you'll see in a minute, they will affect other markets like stock markets, commodity markets, even cryptocurrency markets. So, look out for these, and it's very important to understand when these events happen. So, for example, you can see here 12 o'clock yesterday, we had some big events from the Bank of England. You would have seen it on the news in the UK. That the interest rate was raised by 0.5%. So this is a big event, and you can trade this, make money from it, but also you've got to be aware it's going to happen, so you don't get caught out by it. So what actually happened yesterday lunchtime? We actually had the Australian Central Bank announcing their interest rates on Tuesday morning, overnight really, which wasn't particularly exciting. And then we had this one, which is a big one, 12 o'clock Thursday. So yesterday we had the Bank of England raising interest rates by 0.5%, 50 basis points, which is the biggest raise that they've done, a single raise of interest rates for, I think, 27 years. However, having said that, the interest rate is currently still very low. 1.75% is historically very low. We have had interest rates very, very low for 10 or 12, 15 years now, but prior to that, in the 70s and 80s and 90s, we had interest rates at 5, 10, 15%, even up at 17%, I think, back in the 80s. So, this is still a very low number, but a lot of people have big mortgages and things, and that's why it's going to affect people quite significantly. So the key thing here was that the central bank, the Bank of England, their job is to try to control inflation. And so what they do, they have a meeting every 6 or 7 weeks where they will decide what they're going to do with interest rates. And in this case, they decided to raise them by 0.5% because inflation is so high. Inflation is running above 9% and expected to go higher. And the key thing here is that it's not the interest rate decision that moved the market, it was the commentary and the delivery of this news that affected the price, in this case, of the pound. So what they said it was effectively it's what's called a dovish interest rate hike, which is a bit strange because an interest rate hike is hawkish. Basically, higher interest rates is a hawkish policy and lower interest rates is a dovish policy. But they raised interest rates by 0.5%, but at the same time they said, just because we've done it once, we're not going to do it again. We're going to keep our eye on everything, and everything is on the table. And more importantly, they said, we think the UK economy is going to go into recession at the end of this year in the fourth quarter, and it could stay in recession for the entirety of 2023. So this was a very sort of downbeat message. The upshot of it is that if the country does go into recession for quite an extended period, it will mean that naturally inflation will come down. So it will solve one problem. The Bank of England is in a very difficult situation here because they need to try and calm down inflation. And so they will raise interest rates to make it more expensive for people to borrow and spend, and also make mortgages more expensive so that people have less money to spend, so they'll spend less. And so demand goes down, which means hopefully prices go down, which means inflation goes down. But the problem that they have is that inflation is really being caused by global issues. It's not local to the UK or to Europe or to America. It is global. We've got supply chain issues after COVID. Everyone is now going back to work. They're spending the money that they've saved up. But the problem is that supply chains are being interrupted still with COVID outbreaks around the world and breakdowns in deliveries of goods. And so this is causing the supply of goods to be lower than it should be, which is pushing prices up. Then, of course, we've got the Russia-Ukraine situation, and that has put huge amount of pressure on energy markets, obviously particularly oil and gas, and grain markets as well. So commodities, agricultural commodities. So all of this together is just pushing global prices of everything sky high. And central banks are trying their hardest to get that inflation rate back down towards their target of 2%. And they are failing because it's a global issue which they can't solve with a local solution, and they can only control their own local economy. They're doing what they can, but the problem is here is that by raising interest rates, you're then going to suppress the economy, and actually what it's going to do is possibly force the UK economy into recession earlier and for longer than it might otherwise be, because people won't be going out and spending, they won't have so much money because interest rates are higher, and they won't be able to borrow so cheaply. So it's a very delicate situation. There's no perfect solution, but the key thing here is the dovish tone that was given out by the Bank of England has clearly forced the pound downwards, because they said, we're not necessarily going to raise by 50 pips, 50 basis points every time. And they were saying, we're going to put a damper on this. We expect this recession to come. We're not expecting interest rates to be much more than about 2.5% this time next year, 2.7, 2.8, some of that. So they will go up a little bit more, but not very fast. And so it was dovish. It was sort of saying, we are putting interest rates up now, but we're not that optimistic for the future. The result was a very dramatic move here in the pound. So this is the pound against the dollar. This is the cable exchange rate. This is a 15-minute chart. This is yesterday. The first black circle is yesterday. The second black circle we'll look at in a minute is today's US employment data. But you can see here there was a very quick reaction and an opportunity here to make some money selling the pound against the dollar. Going down here, went down from about, if we look here, 122 when the data came out, down here to a low of around 120.5, 120.60. So it's about 140 pip fall in about an hour, which is a really, really good opportunity. It then recovered towards the end of the day. This was more actually a slightly weaker dollar rather than a strong pound. So the pound was never particularly strong. This was a weak dollar, which was across the board against all of the currencies. And what that meant was any other dollar strength would then be reflected very aggressively against the pound, because the pound underlying strength of the pound is not there, it's weak. And so if you have any other currency against the pound, in this case we're looking at the dollar, if the dollar is strong, it's going to move very quickly. Now, all we need is an excuse for the dollar to be strong. And so what we got was this piece of data here. If we just go and have a look at this. Now this is non-farm payroll. So if we just scroll down a little bit further here, I just need to scroll down like this, and we can see down here, we've just seen here this one, non-farm payroll. So this is the number of new people in employment in the last month. This is for July, not including farm workers, because that's a seasonal industry, and that just detracts from the accuracy of the numbers. So the expectation was that 250,000 new jobs would be created in July, and the actual number came in at 528. So again, the economists have failed dismally in their estimates. Also, to note is that last month it was announced at 372, but it's been recalculated to 398. So another sort of nearly 30,000 jobs from last month, plus another 278,000 on top of the estimate for this month, is like 300,000 extra jobs have been created in America than was expected at 1 minute before 1:30 this afternoon. The result is very strong jobs in employment. Basically means that the Fed, the Central Bank of the United States, at their next meeting, which is a few weeks' time, next meeting, they are more likely to raise interest rates by a bigger amount. And the expectation is now that they will raise again by 0.75%, like they did last time. Which will, we've never seen such speedy rate hikes in the US in history, basically, and so the chances of a 75 basis point rise in interest rates went from 40% chance to 61% chance immediately after this news. Okay, so as a result of that, when interest rates go up, the currency goes up, which means the dollar has gone up, which, as we can see here, sterling dollar has gone down, because this is reflecting a strong dollar. This is the pound against the dollar, so this is the pound going down against the dollar, and it's not the pound going down this time, it is the dollar going up. So this first one was weakness of the pound, and the second one was strength of the dollar, but the effect is almost exactly the same. Okay, we've seen a little rebound here just in the last 45 minutes or so, but the market's still a lot lower than it was when this data came out. One other thing I want to show you here is actually it affects stock markets as well, and this is a very unusual development. Okay, so this is telling us a couple of things. You can see here that this is the Dow Jones. So this is the Dow Jones stock market index. And typically what would normally happen when you have a very high number of people employed, the idea then is that, oh, lots of people employed, that's good because companies are employing, which means they're making more money, which means the stock market should do well. But what's happened here is the stock market has collapsed. The reason for this is that there are two ways, the two different directions being pulled here. One is what I've just said. Lots of employment means companies are doing well, profits should be high, which means the stock market should go up. But in this case, a stronger driver of this particular news was two things. One is that interest rates will go up, and if interest rates start in America, and they should be there by the end of the year, what that means is a lot of people will say, you know what, I can buy government bonds or whatever, and they can do it now at 3%. They can earn 3% on their money. Okay, they're still going to be beaten by inflation, but they can have a nice solid return on their money, completely risk-free. Or you put your money in the stock market, which is much more risky. You may get some dividend yield of around 3% as well, but you may lose 5–10% if the stock market collapses. So it's a much more risky investment. So when interest rates go up, some money tends to come out of the stock market and it goes into fixed income instruments like bonds, where you can be guaranteed a return on your money, and it's ultra safe. It's considered a risk-free investment. Okay, so what happened here is that, in fact, despite the high employment and lots of people, thinking companies are doing well, stock market should go up, actually the stronger driver here was the fact that the dollar was strong, which means that all of the companies in the US who are exporting, Apple, all these big companies, they're exporting a lot of things. When they sell their products in pounds and yen and euros, and they bring it back into America, when they bring it back into America with a very strong dollar, so the dollar is the driver of this move. If the dollar is strong, they'll get less dollars, which actually means their profits will go down because the dollar is strong. So there is an inverse correlation generally between the stock market and the dollar. We saw the dollar going up. Cable going down is the dollar going up, and here we've seen the stock market going down, which is very common and very normal and to be expected. So it's the dollar that has driven this move, rather than the fact that people are employing a lot, and as a consequence of that, you'd expect them to be making money. So it was an interesting move here, and that's why I put these question marks up here. Strong US employment data, you'd expect an upward move, but the strength of the dollar has overcome that and has pushed it down. So whichever way you go, you can do what's called a straddle trade, whereby I'll just very quickly explain this one. You put a buy order just before the news comes out. You put a buy order here with a stop below the recent range and a target somewhere higher, and you put a sell order at the same time here at the same level. So put a sell order down here, and you have your stop loss above the high, and you put a target somewhere down here. Okay, so what happened here is this buy order would not have happened because it went downwards, so you wouldn't have got triggered into that one, and you ended up selling it as the price started to collapse. You would have gone short here. The price collapsed very quickly, and wherever your target was, I don't think you could go beyond 200 or 300 points, but down here you would have taken your profit with a relatively small risk. So it's called a straddle trade. It's a volatility strategy, and what you're expecting there is the market to be very volatile. Whether upwards or downwards, you don't know and you don't care. As long as it goes and keeps going, then you'll make some money. In this case, it went down and kept going down, and so you made some money. Hopefully you would have made some money. The alternative is actually to do a straddle trade on options, where you buy a put and you buy a call at the money. I'm getting a little bit complex here, but what happens is when the price comes down, you make money on the put. Now the price is rebounding, so you'd actually be still on a small loss, but you'd be able to make some money potentially if this rebounds back up towards the starting point. you get some money back on your call as well. So you'd end up making money on both sides of those trades. So it's a more relaxed way of doing the same sort of strategy. But the key thing here is really to keep an eye out for the economic calendar. Look out for these red events, okay, down the middle here, this column in the middle. The red events are the ones that expected high volatility in the market, and they're going to move the market. They will move the Canadian dollar or the US dollar. This is the currency that will be affected by this data. But also, as you've seen there, stock markets will be affected as well. Commodities can be as well. Okay, so keep an eye out for that. If you don't look at the economic calendar in your trading, start looking at it from Monday, because it's really, really important to understand what's going on, because these are the things that move the market. Okay, hope you found that useful. Have a good weekend, and we'll catch up soon. Take care. Bye.